Hello and welcome to this Tolley Seminars online lecture. We're going to be looking at the key personal tax issues coming out of the Finance Act of 2014. Firstly, the personal allowance rose to £10,500 from the previous £10,000 effective for the beginning of the next tax year. So that was announced in the Finance Act of 2014. The personal allowance will increase next tax year by £500, which will gradually, as we see, end what was nicknamed in the press the granny tax. Of course, the difference between the fact that the Chancellor chose to freeze the allowances for the age-related allowances until we actually catch up with the main personal allowance. So there's going to be a gradual creeping up of that over time. So the beginning of the end of the granny tax has also essentially been announced. We're also seeing an incredible squeeze on the basic rate band, in the fact that as we see each budget, the personal allowance goes up, but the entry level to the higher rate also comes down. Therefore, if we carry on this way, we'll actually see no basic rate of tax at all. We'll actually be starting from a 0% rate to a 40% rate. We'll be pleased to know that the Chancellor has announced that we're going to see an end to this shrinking of the basic rate band, in the fact that the entry point for the higher rate threshold will increase each year by 1%. So that is therefore good news, but of course what we do see each tax year, as we see the squeeze in the basic rate band, more taxpayers end up in the higher rate threshold, and as a result there's going to be more tax returns potentially out there to be done. So a work creation scheme for tax professionals. So it's not all bad. He's not all bad. How can any Chancellor be all bad when he's actually trying to create some more work for us tax professionals? Turning now to tax allowances, the transferable married allowance has been announced, whereby the generous amount of 10% of your personal allowance can be transferred between married couples or partners in a civil partnership. So this therefore will start from next April, where essentially where one spouse is not able to utilise all of their personal allowance, they may make an election to transfer 10% of it, i.e. a sum of £1,050 to their civil partner or husband or wife. This is not available, unfortunately, to higher rate taxpayers, so the relief will only be given at any basic rate. So let's just have a look at that in a little bit more detail. So essentially, one party of the partnership must have elected for a reduced allowance. So their allowance reduces to 90% of the full amount. And the other party is therefore entitled then to take that 10%, that's £1,050, and reduce the amount of tax that they pay. This is available where they are married or in a civil partnership to that other party who has made that election. The election is then enforced for the whole of that tax year. The rate of relief is not available to anything other than the basic rate of tax. In other words, it's not liable at any rate other than the basic, dividend, ordinary, or the starting rate for savings. In other words, it's not available at the higher rate of tax. There is also another qualification, as you'd expect, that the individual who is actually claiming this is actually entitled to their own UK personal tax allowance, and neither of them have made a claim for the old married couples allowance, where that was enforced for individuals born before the 6th of April 1935. The election for the reduced allowance is made by individuals who are married or in a civil partnership to a person at the time the claim is made and for part of the tax year. You can only make one claim per year, and you must elect within 4 years of the end of the tax year that you want the claim to be made, and the claim remains in force until you revoke it. And you withdraw it from the next tax year after you have given notice. So the point to bear in mind is you're not making it for individual years, you're making it on an ongoing basis. So therefore, if your circumstances change, you must make sure that you elect fairly quickly that you want to have your 10% of that personal allowance back again. So let's turn now to other areas changing in the Finance Act of 2014. First of all, medical treatment. Employees who are off work sick for a period of time, and there is a recommendation from medical professionals that the individual needs a certain amount of help coming back to work after a particular operation or illness, then the employer is able to make a payment for that medical treatment or occupational health or whatever is required, up to a limit of £500 in any year. And this can be given by a non-cash voucher, for example, a voucher entitling you to the particular treatment at a particular clinic, by direct provision paid for directly by the employer, or by the employee actually going along paying it themselves and claiming it back through their expenses. So the item would obviously go through their expenses, but would not appear, of course, as a taxable benefit on their P11D. There are more regulations on this to provide more detail expected shortly. Turning now to loan interest, the relief that is available to individuals by deduction against their taxable income on a loan that they take out to buy shares in a closed company has now been extended to investing in a company which would be close but is registered in any country in the EEA. So at the moment, previously the relief was only available if you invested in a closed company, which by definition has to be UK resident. Now we're taking that same definition, saying that if the company would be closed if it were UK resident, as long as it's registered in the EEA, then you'll be able to extend that relief. So that's opening it up to more potential claims there. So worth thinking about that in your client base. There's also a similar extension for the rules that apply to employee control company, and there's also now a new definition of close investment holding company for which interest relief is not allowed, and you'll see more detail on that in the supporting notes to this month's release. Turning now to beneficial loans, the limit now has been increased to £10,000 effective from the beginning of the tax year that we are now in, i.e. from the 6th of April 2014. That is good news, of course, because there are some people out there essentially who are having to pay tax on the beneficial loan for a season ticket loan. Because with the way that, as we've seen in the press recently, that season tickets are going up and up and up all the time, there are people with fairly expensive commutes, especially if you're commuting from the far away into the centre of London, that your season ticket could well cost you more than the previous limit of £5,000. Now the limit's been doubled to £10,000, that should remove a lot of those loans out of that. The other thing to bear in mind, of course, that's another £10,000 that owners in their own managed company can actually sort of take out of the company sort of for an 11-month period of the year, again with no tax considerations. Turning now to company car tax, legislation has now been implemented for the changes to the company car code effective for 2016-17. We had previous legislation that had already come in, taking us up to the end of tax year 2015-16. There were other announcements made, but no legislation has yet been put forward. So essentially we are seeing the diesel uplift being abolished. As we saw we actually had to add on another 3% for diesel. That is now being abolished. Non-CO2 car benefits are going to be increased over time, and the minimum benefit on the main table has increased to 15%. And if you turn to your supporting notes, you will see how the percentage of the list price on which your benefit is calculated gradually keeps going up from this year right through to the end of tax year 2018-19. But the last two of those years are yet to be legislated for. But essentially the lesson is that if you've got a company car, you are going to be paying more tax this year and into next. So of course when you're planning which car you want to drive as a company car going forward, you have to bear in mind not only what you're paying now, but what you're likely to pay in the future. And the government, of course, does continue to really rate these zero or low emission cars. But of course, they might not be the ones you actually want to be seen washing on a Sunday morning on your drive. The final area I'd like to look at in this lecture is the whole area around principal private residence relief. This changed effective from the 6th of April 2014, whereby your final run-off period, whereby your home is still deemed to be your principal private residence even though you have moved out of it, that used to be an extension of 36 months, that's now only 18 months. So this particularly affects people on what I would call move to let. So if you've lived somewhere, you then go buy another property and let out your old home, you could continue to get principal private residence lease on your old home for the next 3 years. You can't anymore. That's been reduced to just 18 months. However, there is an exception to that reduction where the individual has actually moved out of their home to move into some form of disabled person or longer term residential care home. The extension continues to be 36 months, but I'll look at that in detail in a few minutes. So the implications for this is that the chargeable gain period will that we were expecting of 3 years has now been reduced. So things to look out for in your client list would be clients who are being cared for by relatives, people with nominated second homes, whereby of course one of the reasons you go for the nominations to get your last 3 years, any buy-to-lets with a letting exemption claim, particularly because that cuts in twice in some cases, and separating couples. For example, where a wife kicks out her husband, he goes and lives somewhere else. In most cases, the divorce settlement is sorted within 3 years, whereby you'll get your full exemption. But in a lot of cases, it's not sorted within 18 months. So if the 18-month point comes, husband will no longer be entitled to PPR and therefore could be exposed to a chargeable gain. Let's turn now to disabled or elderly persons. The last 3-year rule, the 36-month rule, is retained for disposals by disabled persons or persons in care homes. The relief extends to the spouse or civil partner of that qualifying person as well. Now, the thing to bear in mind with this particular rule is actually on the timing. Timing is absolutely key here. If the taxpayer moves out of their home to live with relatives, we are looking at an 18-month rule. If, however, before the 36 months are up, the individual moves out of home with relatives into residential care, then the 3-year rule is reinstated. So there are times when I always say, never let the tax tail wag the dog. But this is a certain circumstance where I would actually perhaps contravene my own previous advice. So let us say that my mother-in-law, who is a delightful lady, I just want to have that known on tape, in case she's listening, delightful lady, is unable to continue to living on her own, and she decides she's going to live and come and move in with me. And after sort of a few months, I realised this ain't working. And I actually say, look, I have your best interests at heart, but unfortunately, when we sell your house, now that we've hit, coming close to the 18-month point, if we sell your house now, we're going to be exposed to capital gain. And being your tax advisor as well as your beloved son-in-law, it is my recommendation that with a heavy heart, that I'm going to have to put you into a home so that we can actually reinstate the private residence relief on your property. Sad though that may be, that might be good advice, and I perhaps on that occasion might let that tax tail wag that particular dog. And just, if I could, just at the end, just spare a few moments to have a look at the impact on the letting exemption of this reduction of the principal private residence runoff from the 36 down to 18 months. Because there is a double whammy here. Because if we think about how the letting exemption is actually applied, the letting exemption is available, of course, when you let out a property that was once your PPR. And the exemption is limited to the smallest of 3 figures. The amount of your PPR relief, the gain arising by reason of the letting, i.e. in the letting period, or 40,000. Now, if you think it's actually the smallest of those figures. Now, let's say you didn't live in a property particularly for a very long time, then this could actually bite quite easily. In the fact the figure of the smallest could actually be the amount of your PPR. Now, the amount of your PPR is now going to be reduced by the fact you've only got an 18-month rather than 36-month runoff. And that not only reduces the amount available for your PPR, but also the amount of your lettings exemption as well. So you actually get a double hit. So bear that in mind when you're doing any back-of-the-envelope calculations for clients you're acting for who are thinking of moving to let or buying to let, etc., what gains might arise in the future. Well, many thanks for listening to this online lecture on the Finance Act issues relating to Finance Act of 2014. My name is Chris Jones, Director of Tax Markets at Tolley.